Economic collapse doesn't happen overnight. There's no countdown, no warning siren. Instead, it creeps in quietly, rising debt, shrinking reserves, weakening currencies. Until one day, a country simply can't pay its bills. As we move toward 2026, economists are warning that several nations are approaching that danger zone. Not guaranteed collapse, but serious default and debt crisis risk. Here are the countries the world is watching most closely. Venezuela. Venezuela is often described as a country that already collapsed. And in many ways, that's true. Years of economic mismanagement, international sanctions, and dependence on oil revenue destroyed the currency and wiped out savings. Inflation turned everyday salaries into pocket change, while basic goods became difficult to import. Even today, Venezuela survives largely through informal markets and foreign assistance. Without major political and economic reform, 2026 remains extremely dangerous for its financial stability. This is what long-term economic isolation looks like. Lebanon is a warning sign for the modern world. Its crisis didn't begin with war. It began with debt. Years of overspending and a fragile banking system led to a complete financial collapse. Banks froze withdrawals. The currency lost most of its value, and millions lost access to their own money. While temporary measures slowed the damage, the underlying problems remain unsolved. Political paralysis and weak reforms mean Lebanon's recovery is fragile at best. One external shock could reopen the crisis in full force. Sri Lanka shocked global markets because it didn't look like a crisis country, until it was. Foreign debt piled up while reserves drained away. Suddenly, the government couldn't afford fuel, medicine, or food imports. Protests followed, and the country officially defaulted. Although debt restructuring brought temporary relief, Sri Lanka's economy remains vulnerable. Growth is weak, and debt pressure hasn't disappeared. 2026 will test whether recovery efforts were enough, or merely a pause before another fall. Egypt doesn't look unstable on the surface, but its risks are deeper and slower. The country relies heavily on foreign borrowing to support its economy. A weak currency, rising debt, and growing import costs have put pressure on government finances. As global interest rates stay higher, servicing that debt becomes more difficult. Egypt's risk isn't sudden collapse. It's prolonged strain that slowly erodes stability. This is what economists call a slow burn crisis. Pakistan. Pakistan faces a familiar cycle. Foreign reserves fall. Imports become expensive. Emergency loans arrive. Pressure eases, briefly, then returns. Without strong export growth and long-term reforms, the country remains highly exposed to global economic shifts. Any rise in fuel prices, interest rates, or political instability can trigger another balance of payments scare. Pakistan's risk in 2026 isn't new. It's unresolved. Why 2026 matters. What makes 2026 different is timing. Many countries are facing higher global borrowing costs, slower economic growth, reduced access to emergency funding. When debt piles up during good times, survival depends on cheap money. When that money disappears, weak systems break. Economic collapse doesn't just hurt governments. It affects food prices, employment, migration, and regional stability. And history shows something important. Countries don't fail because of one mistake. They fail because problems are ignored for too long. 2026 isn't guaranteed disaster, but for these nations, it is a stress test they can't afford to fail.